A 346% jump in revenue? And we're not talking about some tiny startup here, but a massive, established manufacturing giant. Let's dive right into this.
Welcome to the Edgar Brief. Today, we're cracking open the Form 10Q from Micron Technology, ticker MU, filed on June 24, 2026, and we're translating it into plain English. Quick note before we start, we are independent, not SEC affiliated, and we are definitely not financial advisors. We use AI to help summarize these filings so errors can happen. Always verify on sec.gov before making any money decisions. All right, let's get to work.
Section 1. Business Model. What they sell.
To really understand a filing this wild, we have to start with the business model. Basically, think of Micron as a high-tech vending machine for the data economy. The vast majority of their sales come from something called DRAM. You can think of DRAM as a computer's short-term memory workspace. It's essentially the desk where the computer places all the documents it's actively reading and processing right this very second. It's incredibly fast, but when the power goes off, the desk gets totally cleared. In this quarter alone, selling this DRAM desk space brought in over $31 billion.
Now, the other big piece of their business is NAND. If DRAM is that active workspace desk, NAND is the digital filing cabinet. It's where data is permanently stored even when you pull the plug. It's slightly slower than DRAM, sure, but it holds everything for the long haul. This filing cabinet business brought in nearly $10 billion this quarter. So, simply put, they sell the desk and they sell the filing cabinet.
Moving on to Section 2. The Scorecard.
Let's see exactly how many dollars actually walked in the door this quarter. Last year, in Q3 of 2025, Micron brought in about $9.3 billion. This year, about $41.5 billion. That is that explosive 346% year-over-year revenue growth I mentioned at the top of the explainer. Management is explicitly crediting this to AI-driven growth. Simply put, the world suddenly needs infinitely more short-term memory workspaces to train and run artificial intelligence models.
But look, revenue is just the top line. What we really care about is gross margin. How much money actually sticks around after you pay to build the physical chips, but before you pay for corporate payroll, the ads, and the office rent. Micron posted an 85% gross margin, or about $35.1 billion. To put that in perspective, last year, their gross margin was just 38%. This massive surge in AI demand has given them incredible pricing power, driving their average selling prices for DRAM up in the low to 60% range.
Which brings us to the crucial point, operating income. Are they actually massively profitable from the business of selling these chips once all the overhead is paid? Yes, absolutely. Operating income sits at about $33.3 billion. When you look at these numbers, the takeaway label for this company becomes super clear. Micron is a cyclical cash cow that's currently running on an AI steroid injection.
Section 3. The moat check.
So if profit margins are sitting at an insane 85%, why can't a competitor just build a factory across the street and crush them tomorrow? Well, because the barriers to entry here are practically insurmountable. You need massive manufacturing scale. You need highly specialized extreme ultraviolet, or EUV, lithography machines. And you need the deep know-how to build complex 3D stacked memory architectures. You can't just go out and rent a warehouse for this. You need billions in capital and decades of specific engineering physics. It is an incredibly deep moat.
Section 4. Reading between the lines.
This is the part where we decode what the executives are really trying to tell us in the management discussion and analysis. Management notes right here that AI-driven growth has accelerated demand at a rate greater than their ability, and honestly the entire industry's ability, to increase supply. They are flat out telling us there is a structural supply constraint. Demand has violently detached from supply, and that is exactly what's letting them charge virtually whatever they want. And because supply is so tight, their customers are panicking and locking in these new kinds of contracts. The filing talks specifically about newly executed take-or-pay agreements. Think of this like a brutal gym membership contract. The customer commits to buying a specific volume of chips over multiple years at a set price band. If that customer suddenly doesn't need the chips, too bad, they have to pay for them anyway. Whether you show up to the gym or not, they are charging your credit card. Management genuinely believes this transforms their business model into something much more predictable, effectively locking in future cash.
Section 5. Red flags.
Now, it's never a perfectly sunny day in an SEC filing. Skipping past the generic industry filler, let's look at the real headwinds buried in the fine print here. First up, severe geographic concentration. The filing notes that a majority of their 2025 DRAM production output actually came from facilities in Taiwan. Any geopolitical, economic, or natural event there could be absolutely devastating. Second, regulatory lockouts. China's Cyberspace Administration, or CAC, has restricted critical infrastructure operators in China from purchasing Micron products. That permanently limits their total addressable market. Finally, there's the sheer cost of staying in the game. Their capital expenditure burn rate is massive. They spent about $19.6 billion in just 9 months on property, plant, and equipment alone. So yes, their moat is highly effective, but it is extraordinarily expensive to maintain.
And finally, Section 6, the bottom line. Let's pull this all together. The verdict here? Micron is a cyclical cash cow with immense AI-fueled pricing power and a structural supply moat. But they are balancing on top of massive geopolitical concentration in Taiwan and facing intense capital burn risks. Moving forward, there are 3 key things to track in their next filing. First, the pace of their capital expenditures. Are they burning cash faster than they can make it? Second, the sustainability of that wild 85% gross margin. And third, any further impacts from trade restrictions with China. Are we looking at a permanent shift in how memory chips are priced, or just the peak of the wildest hardware cycle we've ever seen? We'll have to see what the next quarter brings. That's your Edgar brief on Micron Technology. Remember, this was a translation, not a recommendation. Read the original on sec.gov if anything here piqued your interest. Thanks for being with us for this explainer, and we will see you in the next filing.